Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
All right, guys, Omar Khan here from the Theta Alpha Fund for the month of October 2025. Let's talk about a little bit about what's going on. I don't want to get too much into my background. I've been around for a long time in the financial space, and we decided to work with Corton a couple of years ago and launched the Theta Alpha portfolio. But we're focusing on today on the labor economic market and the macroeconomic outlook. The same issues still persist that we've had before, which is we have a cooling economy, okay? And we still have high interest rates. That's kind of the worst of both worlds. It's called stagflation. Now, the inflation is high because of all the tariffs that have been imposed, okay? So if you're importing a product from China or from Mexico or Canada, which are the largest trading partners of the United States, what happens? Well, if you're importing something and all of a sudden the cost of that good goes up, it has to get passed on to the consumer. That causes inflation. When inflation is high, okay, the Federal Reserve Bank cannot cut interest rates. They want to cut interest rates, they can't. Okay? So right now the US labor market, it continues to show signs of cooling. That shows a slower economy, not an economy that's in a recession, but a slower economy. The unemployment rate went from 4% at the start of the year to 4.3% now, okay? Now, we've seen a lot of declines in non-farm payrolls, but there's more reports to come, okay? Now, on the inflation side, so job growth and job creation has been weakening. Now, the Federal Reserve cut interest rates once in September, and there are anticipated to be 2 more interest rate cuts by the end of the year. Those 2 more interest rate cuts could help the labor market considerably. Now, the question is why? Why do interest rate cuts help the labor market? Well, all of a sudden, if borrowing money is cheaper, someone's going to look to expand their factory. Someone might buy a home. Someone would invest in something else, a technology company, whatever it may be. What it does, buying cars, what it does is it creates economic activity, which then creates jobs, which then leads to GDP or gross domestic product growth. But the problem is you can't lower interest rates until inflation is under control. Because what could happen is if you just willy-nilly lower interest rates, all of a sudden, all this economic activity starts up and the price of goods and services start going up, and then you have high inflation to deal with. And what is the combat to high inflation? Guess what it is? Got to have higher interest rates. So they've got to kind of wait for inflation to come down. So on the inflation side, CPI, which is the consumer price index month over month, it went up a little bit in April. Fed's preferred gauge, the core PCE price index, it went down 0.2% in August and down from 0.03% in July. Those are still positive numbers. So you're still getting a 0.2% increase, which is 2.4% for the year. In July, it was 0.3, which would be 3.6% for the year. Now, where the Federal Reserve wants to see inflation, is right around that 2% mark. So when you have it around the 2% mark, then they feel very comfortable cutting interest rates. So taken together, softening jobs data and stable to cooling core inflation suggest that further interest rate cuts are likely to support the labor market. Like I said, more than likely, 2 more rate cuts from the Federal Reserve in the United States, and probably 2 more rate cuts this year in Canada as well, okay? So in our view, the deteriorating labor market, okay, would be seen as a signal to cut interest rates, while stable inflation numbers would also be seen in the same light. So I think what will happen is you'll get a couple rate cuts. Hopefully that spurs the labor market on, and it doesn't lead to major inflationary pressure. Okay. Now, if rates are cut, generally speaking, the stock market equities would move higher. Okay. And conversely, if resistance to rate cuts or signs of reaccelerating inflation could weigh on the market. So you kind of don't know how the market's going to go, right? I think what's going to happen is rate cuts are going to happen. The stock market loves lower interest rates. Why? Because that means you have a healthier consumer buying goods and services. Also, companies, if you're looking to expand a factory or do something else or hire people, all of a sudden it's cheaper to do that. If you want to build a new factory or change a line in your factory and you're going to be borrowing money from the bank, well, it's cheaper to borrow money. And since the economy is in good shape, you have more customers who will want to buy your goods and services. So that's why the stock market, generally speaking, loves interest rate cuts. But they're not really guaranteed yet. We're really going to have to see if inflation is able to remain contained. Hopefully it gets a little bit lower, and then the interest rate cut environment can continue to happen. Okay, so just macroeconomic unemployment rate, you can see it's March of last year was at 3.8%. It's been hovering between 3.8 to now it's all the way up to 4.3%. So you can see it does show a cooling labor market. On the right-hand side, you see JOLTS job openings. Now you can see last March, 8.47 million job openings, and this is all United States data. Now we're down to 7.23%. Non-farm payrolls. That means jobs that are added per month that are non-farm related, okay? In August of 2025, only a meager 22,000 jobs were added. And you can see the trend is clearly downwards. So the unemployment rate trend is upwards. The jobs openings is downwards. And the non-farm payrolls, the net new jobs created, is also trending downwards. So if inflation is under control, this gives the Federal Reserve all the reasons in the world to cut interest rates because things are not headed in the right direction, okay? Now, this is the important part here, okay? Look on the top left-hand corner, macroeconomic environment, CPI, Consumer Price Index, what we pay for stuff on a day-to-day basis, okay? Now you can see it's at 2.9. They really want to see this number right around 2%. But right around that time that tariffs were introduced, you can see that number was all the way down to 2.3%. Okay, in April of 25. But now it's been creeping back up because, like we talked about, if all of a sudden it costs more to import something from Mexico or China or Canada, and you need it, like you can't grow an avocado, it can only be done in certain areas. And your manufacturing is not cheap enough, so you outsource it to China. Now, when you're bringing those things back, or oil and gas from Canada, if all of a sudden you put a tariff on it, guess what happens? The U.S. consumer pays more. And that's being reflected in this inflation data. We want to see this inflation number come down. Okay? Now you can see the core PC excludes food and energy, which food and energy are vital to our lives. But anyways, it's at 0.2% here in August. That's a 2.4% annualized rate. Again, you want to see it closer to that 2%. The Federal Reserve will feel a lot more comfortable cutting interest rates when it's at 2%. Now, I just want to talk about most funds don't beat the index over a period of time. As of yesterday, this is a 10-year number. We think the next 12 months in the stock market is going to be pretty good. But there's, of course, no guarantees because of the interest rate cutting environment that we're in. What history tells us is, on average, if you have an interest rate cutting environment and you have stock markets at or an all-time high and no recession, those three factors, the average return on the S&P 500 after that in the last 41 years has been 18.2%. So most funds underperform their benchmark. How have we done so far this year? Well, our main fund, our Class A fund, is up 21.86% for the year. That is a little bit, that's approximately 5% above and beyond the index, okay? So when 90% or 80 to 100% of fund managers can't beat their index, and we've beaten it by approximately 5% this year, it's something we're very happy about, and we look to continue that in the future. And we think it's because one of the main reasons we don't hold a lot of stock. You can see a lot of the popular funds in Canada hold a number of holdings. We hold 12, but we know those 12 names very, very well. Inflation continues to erode the value of the consumer. Purchasing power continues to go down. Expect this trend to continue because governments around the world are very, very indebted, And one of the ways for them to become less indebted is to print more money. What does that mean? That means the value of existing money continues to decline. That means when you were a kid and you went over to the convenience store and you bought a pop for 25 cents, which I remember doing, and now that same, well, they don't even have them anymore. It was a glass of, a glass bottle of Coca-Cola. Now you can't even buy that anymore, but it's considerably more expensive. That is inflation. This will continue to happen. And this is one of the reasons we hold Bitcoin as a holding in our portfolio. So what do we do differently in our portfolio? Like we talked about, we have a small number of holdings. Okay. We sell options on them and we use seasonalities. Now, seasonality is the stock market generally does really well from the end of May to the beginning of, the end of October to the beginning of May. And from the beginning of May to the end of October, it doesn't do that great. It's more flat. So we definitely take that into account when looking at how to allocate our money. Now, you don't need a whole lot of stocks in order to be diversified. You need around 15. We have 12. We're looking to add a few more in the future, but that's where we are right now. 12 stocks, 15, you get some pretty good diversification at 15. You don't need 200 like the average mutual fund in Canada. That's not how you beat the index, and that's what we're looking to do, okay? Now, this is the Magnificent Seven compared to the S&P 500 just this year alone. Last year, excuse me. You can see last year, the Magnificent Seven companies, which are the technology companies, the companies based around artificial intelligence, up 70% for the year. The S&P did very well as well at 24%, but that 70% is a big beat, okay? Now, how quickly are these technologies being adopted right now? We have a couple technologies. One is Bitcoin, and the other one is artificial intelligence. Now, artificial intelligence could be the biggest technological advance in the history of humanity, but time yet still has to tell what shape and form this will eventually take. But what we're pointing out is these technological changes, they happen rapidly. We'll see how quickly this one happens, okay? Now, this is the growth of the U.S. stock market and bond market and other markets, real estate market over the last 15 years. If you look at the top second line from the top, the QQQ NASDAQ 100, that is the category we are mainly invested in. And if you go all the way to the right and you look at the 2011 to 2025 cumulative and annualized numbers, you will see that had you invested in 2011, you would be up 1,058% just if you were in the NASDAQ. That correlates to an 18.4% return per year on average. Now, artificial intelligence is just at the beginning stages. We don't know how it's going to play out. We think it's going to be very positive for productivity, for humanity as a whole, but we'll see. And how much profitability will each company derive from this? We think it'll be quite substantial. But again, there are no guarantees. Time will tell. This is what history tells us. Now, one thing that the stock market is, especially in technology, is it can be very volatile. So when you have negative years in the stock market, especially in technology, you can see how bad the numbers can get. In 2022, the NASDAQ was down 32.6% for the year. That's a big drop. Now, there were drops across the board in pretty much every asset category. Okay, but for example, if you held gold, you barely lost anything, 0.8%. So when you invest in a category like artificial intelligence and technology, there's a high likelihood that you will get outsized gains over time. However, the price to pay for that is a lot of variability. So what you'll need is a longer time horizon. And that's what we're very straightforward about. Now, here's our holdings in our portfolio. You can see, again, we only have 12 holdings. A lot of them are focused around artificial intelligence and the companies that will benefit from artificial intelligence. Microsoft, Tesla, NVIDIA. Eli Lilly is one that's a bit different. It's a healthcare company. Doesn't really have anything to do with technology, but for us, it is a holding that we are confident we wanted to have, and it's also a diversifier. You have Amazon, Alphabet, which is Google, Facebook, which is Meta, AMD, which has been an absolute terror of late. It's helped us in achieving that 21.86% year-to-date return. We held a good percentage of it, and it's gone significantly higher. Bitcoin through IBIT, we have an 8% holding in that as well. Taiwan Semiconductor, Apple, and lastly, Constellation Energy. Now, Constellation Energy is a newer holding of ours, and it is mainly because the data centers required to fuel artificial intelligence, Well, guess what? They need a lot of electricity. That electricity will partially be provided by Constellation Energy. They are great at making nuclear energy. Okay. So, like I said, our returns so far this year, 21.86%, right around 5% above beyond the index. These are the tenants that we stick to. When you only invest in 12 companies, you understand those companies very well. So, for example, investing in Tesla, which is our number 2 holding. Well, when you drive a Tesla every day and you use the full self-driving software, you have a much better idea as to what this could mean for the future of the company when you use their products and services. So when you invest in a small number of companies, you do it with more surety because you understand the companies well. And if you are correct in your assessment, it can have a very positive effect as it has so far this year. Okay. Please, if you want to get in touch with any of us, contact myself on the left-hand side, Matthew Todman, or David Jarvis. And as always, we have a disclosure. Please read this at your leisure as you will get a copy of this. And here's another disclosure, more disclosures, and that's it. Otherwise, look forward to talking to you guys next month. Take care.